Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of those disclosures that you might find therein. So the U.S. Debt ceiling debate has been making major headlines. It's hard to open up a newspaper or turn on television and not hear pundits talking about it. Even the Biden administration was warning of a potential default if an agreement's not reached soon. Now, while the U.S. does have enough revenue to pay bondholders, a $1.5 trillion deficit this year means it may not be able to meet all of its obligations, including those entitlement payments that we all like Medicare, Medicaid, and Social Security. However, despite the current concern, it's likely we feel that an agreement will eventually be reached and all bond payments will be made on time. There's also little likelihood of any entitlement payments being delayed, so I think you can expect to continue to receive your Social Security checks. It's more probable that Congress and White House will agree to hold the line on increases in discretionary spending and form a bipartisan commission to review proposals to reform these entitlements. But even if an agreement is reached to limit discretionary spending, history shows that those limits are unlikely to last. Non-defense government spending has grown 10 times faster than GDP, or the size of the U.S. economy, over the last 90 years. And this trend is unlikely to change anytime soon. Additionally, if an entitlement commission is formed, any recommendations would not likely come up for a vote until after the next presidential election and would likely fall short of the necessary votes. The path of federal spending, dominated by entitlements, is unsustainable. This year's Social Security, Medicare, Medicaid, and other health-related entitlement programs will cost the federal government 10.8% of GDP. 30 years from now, these same programs are projected to cost 14.9% of GDP. Tax revenue is scheduled to be higher, but the gain in revenue relative to GDP is less than 1 percentage point, which is well below the expected increase in spending. The real problem isn't whether the U.S. raises the debt ceiling right now, because since the beginning, the first debt ceiling raise that occurred, they've raised it 78 times since then. So the problem isn't whether it raises the debt ceiling now, but how the U.S. will pay for all this spending over time. Simple budget accounting trends forecast a huge increase in federal debt, which means huge increase in net interest payments by the government on their debt. At some point, the U.S. will either reform entitlement programs or raise future taxes to pay for them. Reducing entitlements would help keep more workers in the labor force and more dollars in the private sector, boosting future GDP growth. On the other hand, higher future taxes would put the U.S. on the same path as many European countries with a huge size of government. This creeping Europeanization of the U.S. would suppress future work, saving, and investment. Worse, the process would be gradual and much harder to notice than a tidal wave of interest payments. While most investors are focusing on whether debt payments due this summer get fully paid, wise investors need to keep their eye on the key long-term issue. That is, will politicians make progress in limiting future spending? If not, the U.S. will continue on its long growth path, slowing down over time. So they need to cut spending, and this is a conversation that they need to have coming up in June. Once again, we don't feel they default on their debt. We feel like they're going to pay their debt holders, all their bond holders. But once again, you can't spend trillions of dollars more than what you make. I think we all know that. Have a wonderful day. Call us if you have any questions.